Hello, welcome to chapter 11. We're going to continue talking property, plant, and equipment, but this time we're going to be talking and focusing primarily on its usage and its disposition. In other words, whether we're going to scrap it, sell it, and how we're going to handle those types of things. In your prior accounting classes, you should know that your depreciation is used for your property, plant, and equipment. Depletion is for natural resources, and your amortization is for any kind of amortizable intangible assets. There are other aspects within all of these things that you can test for impairment that primarily focuses on intangible assets that don't have a useful life, but can also be utilized for other areas within these costs. Cost allocation: when we buy something in one accounting period that will last us more than one accounting period, we must spread those costs out. That is what we are doing when we use this cost depreciation, depletion, and amortization. That's the whole point of that, because we got to fulfill and honor the matching principle. We can't expense, in this case, the purchase of a truck for $82,000 in year one. We have to spread those costs up over the useful life. And the point of the residual value is because we can't expense $82,000 full dollars if we know that we can sell that truck at the end of year 5 for a certain amount. Because then we're reducing our net income, or in government's words, taxable income, more than we should have, even though in that last year we would recoup some of that as a gain if we sold it anyway. But the bottom line is we have to give it our best shot. We have to make sure that we're doing our best in these estimates to reflect the accurate amount of expenses throughout the accounting periods. Now, most of the methods that are out there, the most common is the straight line. But of course, because there's other possible methods, and there are some companies that for whatever reason use these other methods, we're going to teach you them, and we're going to actually introduce you a new one. If you took my accounting 111 or 211 class, we went over 3 specific ones. Sorry, 4. But oh wait, no, it was 3. Anyway, we're going to go over another one in this one as well. But anyway, what we need is the service life of the asset, what the allocation base is going to be, whether it's straight line, just years, or whether it's the allocation base is the acquisition cost minus the residual value. So we need to know and this one uses residual value. You might be familiar with salvage or residual. Either one, they're synonyms. They're meaning the same thing. And then the allocation method, basically the pattern which we allocated, that's going to be your depreciation, depletion, or your amortization method. So our service life is basically however long we expect to use it, or in times of in looking at like the units of production method, we need to know the units of activity that's going to be associated with that. So looking at it from the standpoint of a vehicle, that would be probably miles driven if it's the units of production method, or it would be the time in which we thought we were going to use it. Could be 5 years, 3 years, whatever. Depends on the experience. So for example, if I bought a truck because I just want to drive around town and whatever, that's going to last me probably a good 5 years. But if I'm a truck that is like your regular pickup truck, but I'm hauling dirt and stuff, that might not last as long. So there might be a reason why we wouldn't go 5 years. We might go 3 for that one. Service life does not necessarily mean the physical life of the asset, and usually it doesn't. And the reason is because we're going to use it for a certain amount of time for the purposes which we want to. Think of not a dealership, a car rental place, right? They're going to want to use those assets for a certain period of time, but once the mileage gets to a certain point, we don't want to continue using it. And therefore, we're going to get rid of that vehicle after a certain number of miles so we can sell it to get the most from that sale, but at the same time, keep a lineup of cars that are relatively new and in good shape so that our customers are driving reliable vehicles. The allocation base, again, is typically going to be the initial cost, whatever we paid for it, minus its salvage value. And again, remember, this is an estimate, the salvage value. We don't really know what we're going to get in 5 years for whatever it is. So it's going to be our best guess. The allocation method, again, represents the the type of method we're going to use. Time-based is going to be based on the passage of time, and activity-based means that the number of usage of that asset. Time-based includes straight line accelerated methods. Here's a new one that I haven't talked about, although I may have mentioned it before, is the sum of years digit. It makes no sense, but it's available. Like I said, or not like I said in this video, but prior classes, you can come up with any amount of different depreciation methods. In fact, if you come up with a really good one and copyright it or something, then maybe you can make some money. I don't know, but bottom line is, you can come up with any method as long as it makes sense and is following the matching principle. Then you probably could use it as long as there's a good reason for it. But the more complicated it is, the harder it is to calculate, things like that. Activity-based methods usually is the units of production, and there's really not many more of those, at least not that we're going to go over. Method means exactly what it means. Is no matter how much usage you use that asset as, it's going to be the cost minus salvage value divided by the useful life, and then that is the amount of depreciation you will do every single year until the time you dispose of it, or excuse me, until it's fully depreciated. So here's your formula. You can look at that right there. I'm going to go to this one. It's going to show you here. Now they give you this rate, this 1/5, and that's because when you look at the number of years, and I don't see that it says that here, but let me go back this slide. It says actual production during the 5 years. Okay, it's given us that, and estimated useful life of 5 years is indicated there. So here they're just showing the rate of the depreciable base as 1/5. It's because every year is 1 year out of the 5. That's the only reason why they're doing that. Okay, and the reason why we do that is when we get to the accelerated method, typically we double or triple that rate. So we'll either put a 2 or a 3 on top of that 5 instead of the 1 that's there in that depreciable rate per year column. At any rate, you can see every year depreciation expense remains the same until we depreciate the last time. In year 5, depreciation expense totals $210,000 over the useful life. Accumulated depreciation accumulates to being 210, and the book value at the end of the depreciation periods is going to be the residual value. That's how it should be for every depreciation method you use. Your journal entry to record this should be debit to depreciation expense, credit to your accumulated depreciation, which bonus, what is the type of account accumulated depreciation is classified as? Your answer should be a contra asset. Now, this should be very familiar again. This should be a refresher for you. You should know this stuff from your financial accounting, but hopefully this is a good refresher for you. So here's your double declining balance method. All right. Now I love on the other one, they showed it as 1/5. Now that we've decided to use percentages. If we used instead of 1/5 on the past one, it would have been 20%. Here it's going to be 2/5 or 40%. I don't know why. That was brilliant of the authors to do this. Bottom line is the rate is 2/5 or 40% instead of 20%. But instead of taking it based on the depreciable cost, we're doing it on the book value of the asset at each year. So in the first year, 40% after book value of 250,000, we're going to depreciate 100,000. That's going to leave us $150,000 of book value at the end of year 1. Beginning of year 2, we're going to take 40% of 150,000, which is going to be a $60,000 depreciation expense. And so on until year 4, when we realize we can't depreciate at 40% because that would make us go below $40,000. So we can only depreciate that $14,000. In year 5, we don't get to take any depreciation expense because we're already fully depreciated. So, but once again, looking at the 2 different depreciation methods that we've seen so far, we have the same number there at $210,000. So if for some reason you need to have these assets produce a high amount of depreciation expense in the early years, okay, this is your method. But if it doesn't matter, straight line is just easier and your accountants will love you. All right, here's a new one that I haven't taught you guys, or that you maybe haven't been exposed to yet. It's called the sum of years digits. Basically, we think that this is going to be 5 years. So we're going to take for 5 years. In year 1, it's 5. In year 2, it's 4, 3, 2, and 1 until year 5. You add up those numbers, 5, 4, 3, 2, and 1, you get 15. So in year 1, you're going to take 5/15 of depreciation of the depreciable base. In year 2, 4/15, and so on until year 5, it's 1/15. It's another way of accelerating the depreciation, but maybe it's not as accelerated as the double declining balance method. But bottom line is, again, you get to the accumulated depreciation of $210,000 and your book value is $40,000. So once again, you're only depreciating it to exactly where you're going. So why aren't we depreciating this at the straight line method? Why come up with these more challenging ones? But they are available if you want them. And then we have our activity-based depreciation method, which is the units of production. Bottom line is you estimate how many units you think you're going to be able to use the machine for. Then as you go through each year, however many units that are produced, you're going to take that and divide it by the total amount you think you're going to produce. Now, we estimated 140,000 units is what we're going to produce out of this machine. But if you look at the actual production, we're going to see we actually produced 150,000. What that's going to do is in year 5, we're not going to be able to take the full depreciation based on our percentage or rate that we came up with, because we produced 10,000 more units than we thought we were going to. So in year 1, we're going to take a $30,000 depreciation expense because we produced 20,000 units, and we've come up with a rate. Take our depreciable cost, which is historical cost minus the residual value, and we divide it by what we expect our production is going to produce. In this case, we expected 140,000 units. So we came up with $1.50 per unit. Then we're going to take 20,000 in the year 1, multiply by 1.5, which is at $1.50. Our depreciation expense is $30,000. And we're going to do that in every year, but except in year 5, if we took 26,000 multiplied by 1.5, that would have given us too much depreciation expense. It would have made it to where our book value would have dipped below 40,000. We can't do that because we expect to sell this asset at 40,000. Now, if at some point we have a change in accounting estimate, we can deal with that, and we're going to talk about that here in a minute. But that's the only thing that we could do is if we're changing our book value or our residual value, is how we would depreciate this further. But that's not the issue here. Bottom line is, can't depreciate it below our salvage value, so we can only take so much of a depreciation expense in that last year. So here's your comparison of various depreciation methods, and I don't care which depreciation method you use, you're going to end up with the same total amount of depreciation for each one of them. So if you ever go to work for someone and they say, yeah, we're going to use the sum of years digits, just look at them with a very inquisical look on your face and just simply ask why. And they're not going to have a good reason for it, because there's really no good reason. And there is. Obviously, look, straight line method, it's 42,000 every year, but units of production follows the flow of the actual usage. Some of years digits and double declining are accelerated. You get more in the early years of depreciation expense and less in the later years. Maybe they have a dang good reason. I don't know what they are. Here's what I basically just went over. Why would you use them? Pause the video and read these if you want, but don't care about IFRS. Half-year conventions. What happens when you purchase your unit in the middle of a year or something? Well, it depends. You can take a half year, you can take a half quarter, you can take half a month. I mean, you basically can do whatever you want. But typically in the year that an asset is introduced, you're not buying it on January 1st, like most textbooks have said, right? You're buying it on April. In fact, you're not even buying it on April 1st, you're buying it on April 10th. And so you just have to come up with a way to do that. In this case, we're going to look at this as a partial year depreciation method. In April, we're going to take 3/4 of that. Since it's April, the beginning, we've only missed 3 months. So we're going to take 9 divided by 12, which is 3/4 in the first year. And then, and we're doing that for every one of these depreciation methods, except the units of production, because the units of production method, it's whatever we produced. But then the last year, we're going to take that 1/4 for straight line method. And so by the time the double declining balance method happens, you've still already depreciated the amount fully. Units of production, if it gets in, you're depreciating it in the last year anyway. The real one, it's going to stretch the straight line method into an additional year by calendar year. I mean, because you're basically shifting that schedule down the timeline by 3 months, and so you're gonna dip into that next year at 2032 for 3 months to calculate the rest of that depreciation for that asset. But as you can see, you still get to the same amount. All right, what do we do when we're going to dispose of our asset? Well, if we receive any kind of consideration, whether it's another piece of equipment, money, or whatever, or maybe it's a loss because of a fire and you're getting proceeds from your insurance company, it doesn't matter. Whatever the case is, whatever you're getting is going to be the amount you get. Then you're going to subtract out of it the book value of the asset. So take your original cost minus your accumulated depreciation. And when you subtract the result of that out of the selling price or the what you received, if it's a positive number, it's a gain on the disposition of the asset. If it's a loss, or if it's a negative, it's a loss on the sale of the asset. Let's look at an example. I'm sure we're going to get one on this next slide. All right, so we have a machine, 250,000, residual value is 40,000. So we don't hold it for 5 years. Instead, we sell it 3 years later for 140,000. And what we want to do is at the end of that year, we're going to update our depreciation because we have used it for that 3 years. So our accumulated depreciation in this circumstance is $126,000. So we do our journal entry. Then we're going to account for the disposition of it. We get $140,000. Original cost was $250,000. We subtract out the accumulated depreciation of $126,000. That results in a book value of $124,000. Subtract that out of the selling price, and we have a gain of $16,000 because that is a positive number. Debit to cash, the $140,000. All your numbers are listed when you do it the way I just showed you here. All your numbers are listed that you need for the journal entry. Okay, you don't need that 124. That was just for your convenience as far as math goes. But you're going to debit the cash, debit the accumulated depreciation, credit the equipment, and in this case, credit the gain on the sale. If it were a loss, you debit the cash or whatever consideration you got, debit the accumulated depreciation, debit the loss, credit the equipment. Okay. Oh, let's assume now it's 110,000 instead. Okay, now we're going to have a loss. $110,000 minus the original cost minus accumulated depreciation. Now we're a $14,000 loss. You get the journal entry right here. It's just what I just described on how it would be if it were a loss. In fact, I'm just going to go back a slide really quick. Okay, it was $16,000 gain, 14,000. All right, a gain on the sale means that we sold it for more than book value. It's not an economic gain, is what this is saying. It's not an economic gain, and we sold it for loss. It's not an economic loss. It is simply we sold it for more or less than what we paid for. It's just kind of how it is. Now, what if we have an asset that we're holding for sale? All right, it's just something that we're going to have. It's reported at the lower of its cost or market or fair value, in other words, less any cost of sales. That's its net realizable value. Okay. Same thing we dealt with when we were dealing with inventory. Cost minus cost or fair value. It's basically inventory if we're holding it for sale. That's why we follow that rule. We're looking at it at this point as inventory. If we're retiring it, we're just going to debit the equipment, or sorry, debit the accumulated depreciation, credit the equipment, and indicate any gain or loss on that retirement. Now's a really good time. I know we've only gone through a handful of slides, but this is a good time for that word now. Let's do it. The word is April. APRIL. Does not matter if it's capitalized or not. APRIL. Alpha, Papa, Romeo, India, Lima. April. Okay. Group and composite depreciation methods. So a lot of times, especially with really large companies, you're dealing with a ton of assets, and to track each individual asset it's not cost beneficial. You don't have a lot of gain in the knowledge of each individual asset and where it's at. So a lot of times what we're going to do is we're just going to, as we buy new assets, we're going to lump them together, and as we sell assets, we're going to pull them out. This is what we call group depreciation. So if we're going to group these together, we're going to take the $330,000 and we're going to find out our depreciable base, our estimated life. See, this is where I don't know. Okay, so we're going to calculate our rate by taking our, if we did the straight line, 52,000 in. I'm even going to say that even this is a bit involved, and this is fine though. You're going to take your, what it would be if it were straight line, come up with a rate, and then you're just basically going to take that asset and group and depreciate that 16%. That says the average service life. So this is if you have a group depreciation and all you're doing is depreciating this group and you keep this group together. It wouldn't work if you're adding or subtracting any, okay? That's just my professional opinion. I think this book's calling it composite depreciation when we're constantly adding and taking stuff out. So whenever we sell, it's the same way we're selling it. Any gain or loss is included in the accumulated depreciation account. All right. So just really quick about a little bit more about this too. So the way I've seen it in my personal life is more, I guess, maybe the composite depreciation method is what they're talking about. Bottom line is when we gain something, we're putting it in this group, this pot. Think of it like a boiling pot. We're just throwing it in there, and eventually we're going to take some stuff out, but we don't know what was in and what was out and all that other stuff like that. All we're going to do is just take out what we put in. We're going to take the full amount of the asset as accumulated depreciation, and it basically means we're going to just depreciate this account in perpetuity. We're gonna just constantly have something in there to depreciate, unless we just never add anything for a long time, and then eventually we get to that accumulated depreciation. Until then, it's just we're going to constantly be depreciating out. And I see that a lot, even smaller companies, but they do have things that they just can't keep track of. Like I've audited water companies before, and how do you know which piece of equipment you put in the ground, like pipes and things? But it's asset, it has a useful life, and we're depreciating it. But if they have to pull one out and put something else in or whatever, I mean, it's just you can't keep track of that. That's just insane. I mean, it's not insane. It's actually really cool if you could, but it's the cost benefit constraint. The benefit doesn't outweigh the cost. Benefit isn't better than the cost, whatever. All right, in our notes to the financial statements, we're going to put in there our significant accounting policies on identifying exactly which depreciation method we are using, and most likely it's going to be a straight line. All right, natural resources. So we have a depletion base, and I'm looking and seeing if they're bringing this up. Our depletion base is going, well, we haven't talked about it. Maybe that's what it is. Just this is our formula, depletion base divided by how much we think we're going to pull out. And our depletion base is cost minus residual value. Now, I'm not sure if it's going to do this in a later slide, but we also have to consider how much it's going to cost us to restore the land back to a more natural condition. Most governments aren't going to let a company come in, mine someplace out, and then leave all these open mines and shafts for people to go into and have accidents. Okay, so they're gonna be tasked to collapse the mines, the shafts, if those are a thing, cover it up, replant trees, and basically turn it back into something that people can enjoy, or at least just make it back to what it looked like naturally, or what it could have looked like. That should be also included in that depreciable cost, or that depletion based, not depreciable, depletion based. Oh yeah, here it is. Okay, yeah. So it's basically that number four, expected cost to restore the land after excavation is complete. Okay, yeah. I didn't know. Okay, I didn't know they were going to it, but I jumped the gun. Either way, but you get the point. All these things, all the stuff, all the costs, all these things that we need to develop the site and everything and stuff like that is part of the depletion base, including, in this case, the right to explore copper deposit. Of course, in Pennsylvania, do they mine copper in Pennsylvania? Man, it should be Arizona. Should be Arizona. We do copper in Arizona. Anyway, you see how we do. We expect to extract the million tons So we take our depletion costs. And so for every ton we pull out, we're going to depreciate $2.77. I don't know that we're going to really want to take that to 5 decimals in a calculation, but apparently we are in this situation. Whatever. I wouldn't. I would stick to the 76 cents and then adjust in the last year. Bottom line is we're going to debit depletion, credit our copper deposit account. Depreciation on the equipment used in extraction. Okay, we can use the extracted units in this case as well. This is no different than the units of production method. You come up with the rate and then depreciate it based on that rate. And that's exactly what it is. It's the units of production method rearing its awesome head. Sorry, I was bouncing between the two, and I think I may have hit the wrong one. No, okay, all right. Sorry, here we go. Depreciation base divided by the extractable units of production method. That's how we do it. And then we have a depreciation on the equipment, depletion on the mine itself. Okay. All right. And we don't care about IFRS. If you ever want to pause the video on that, I do kind of leave it up for a second or two. You can read about it if you want. You're never gonna get anything IFRS related from me though. Can't stand IFRS. I don't remember if I mentioned this before, but we were trying to do a convergence process. The United States was with GAAP and IFRS, and just got to a point where I think people realize this is stupid because IFRS, I don't know, it's like trying to merge an apple and an orange. You're just, you'll find some similarities. They're both sort of round and they're both have a skin on them, but one you can eat and one, if you eat it, you're weird. Okay, finite life, intangible assets subject to amortization. Finite means you can determine a useful life. I wish they'd just say it out in English. Finite, I have to see it. What does that mean? If you know how long your asset's going to last, your intangible asset, then you're fine. Okay, you can amortize it. If you can't, we're gonna do something else. So if we believe, and here's the thing, we only amortize it over the amount of time we expect to use it usefully. We may have a legal life, and in this case, number 2 here, it says the remaining legal life of the patent is 13 years. However, due to expected technological obsolescence, company estimates that the useful life of the patent is only 8 years. We get to use 8 years. Okay. So in the first one, franchise is 200,000, and we have it for 10 years. Just divide that by 10. In the other case, it's 50,000 divided by the 8 years. We're recording the amortization of the franchise and/or the patent. Really easy. There is no residual value for intangible assets, at least not that I've seen. So really easy to do. Here's another example, I guess. Oh, here we're selling the patent. Okay. So we're going to credit the patent. Because remember, we're actually reducing the patent when we amortize it. So whatever the amount left is in that account, we're getting rid of the amortization expense. Or I'm sorry, we're amortizing the expense in the amount of the patent. Okay, this slide, I'm looking at this. Literally number 2, a patent for $50,000. What does that even mean? So we've acquired this patent after 50 years. Sorry, 5 years. We sell it for $21,000. There's no cash. There should be a debit to cash here? I don't know why we're amortizing the expense of it. I'm going to need to look into this, guys, but this should be a debit to cash, credit to patent, credit to gain on sale of patent. We can do any amortization expense we might need to if it's at the end of the year, which it looks like it is, fine. So we amortize it for 1 more year and then we sell it. But this journal entry doesn't reflect the cash received. Okay. And that actually might impact whether this was a gain or a loss. In fact, it would make it more of a gain because you're going to have a higher amount or a reduction to the patent if it wasn't recorded. This isn't a very good slide. I just caught that. Glad I did. Okay. So we should have in the second journal entry here, we should have, see, I don't even know why a franchise. I think somebody was high when they did this slide. They were like on something. A franchise from Ajax Industries. Oh, the company purchased the following two intangible. Okay, now at least that makes more sense. But it still doesn't matter because 200,000 franchise agreements for a period of 10 years. Why? Why is the amortization? Are we only do? Oh, we're only doing. Okay, I'm sorry. This is taking me a second to really. I thought the amortization expense that is recording that says franchise. It shouldn't say franchise. It should be the. This is weird, guys. Just ignore this slide. I don't know what to tell you. This one, I can't make heads or tails because the first one, if we're doing the franchise, it should be 200,000 divided by 10. That's the amortization. It's just exactly what this one was. Why would it change? It's like literally the exact same problem, except in this case, we're just selling it. And yet now they're saying this no, this is somebody messed this slide up in a bad way. Okay, guys, this one's really bad. Don't just that one's really bad. Okay. Software development costs. All right. We have two methods. We take the greater of the percentage of revenue method or the straight line method. So we have R&D, software development costs. Okay, however much it takes us to determine, we're going to. So let's just look at this one. The Astro Corporation develops computer software graphics programs for sale. A new development project started in 2026 and reached the point of technological feasibility. Prior to June 30th, 2027, we have 1.2 million. After that, 800,000. Software is available for sale January 1st, 2028. And we have the following related sales information. Sales in 2028 was 3 million. Estimated in 2029 to 31 is 7 million, total $10 million. Okay, determine expensed versus capitalized in 2027. Well, we're going to expense everything up to the point of technological feasibility. Once we do that, everything else is capitalized. We expense the other stuff as R&D, and we capitalize the remaining once it's technologically feasible. So the percentage of revenue method is we're going to take that $3 million. I'm going to go back here to that sales in 2028. We're going to divide it by the base of 10 million, which was the 3 million, going back again, 3 million plus the 7 million in estimated sales. So we think 30%, and we're going to multiply that by the $800,000 of our capitalized costs. That is our percentage of revenue method. Straight line method is 200,000. Okay. Now let's go back to the rule. This is the greater of the percentage of revenue method or straight line method. So the greater one in this case is the percentage of revenue method. So our amortization expense for the software development cost will be $240,000, and we'll credit software development costs $240,000. Don't care about IFRS. Okay, indefinite life. In other words, we do not know what our useful life will happen. Okay, we don't know. All we're going to do is test for impairment. In other words, we don't know what's going to happen. We're going to see if it's still good. If it's not good, we'll do some. If it is good, we'll just leave it alone. Trademarks, trade names, goodwill, all that stuff are indefinite. We can have them forever. All right, changes in accounting estimates, all right, or change in estimates. They are not errors. They are not errors. Errors, you have to go back and change prior financial statements. Changes in accounting estimates are not errors, and therefore we only have them impact the current and future periods only. Okay, we call that prospectively, accounting firm prospectively. So change in accounting estimate. So we have an asset. We've depreciated it for, let's see, what is this? Time purchase, okay. Then 2 years later, we revised our estimates. Service life from a total of 5 to a total of 8 years. We've already depreciated it for 2, so we got to divide that by 6 years, not 8. Residual value went from 40 to 22,000. So we're going to recalculate. We need to take the book value. $250,000. We're going to minus out the new residual value of 22,000, but we're also going to subtract out our accumulated depreciation, which in this case is the $84,000. So once we do that, our depreciable base is 144,000. We divide that by 6, which is the remaining useful life in years left. Our new annual depreciation is $24,000. Again, if you took my class in 111, we did, or in 112, we did a whole memo on this situation. So, but that's how we handle it. Change in estimate disclosure. You need to let people know you had situations where you've changed your estimates. Same with depreciation, amortization, or depletion. You change it, you need to do it prospectively and inform the general public through your financial statements. If you change your depreciation method, say you go from one to the other, then you're going to need to do a little bit of extra work. You're going to need to, you know what, actually, I want to see what they were saying here. So in this case, we're going from, what was it? What's the beginning one? Doesn't even say. Double declining balance, depreciation method used, could be switched from the double. We're going from double declining to the straight line. So it's similar to that. It's basically another depreciation method is a little bit more serious than just changing the accounting estimate, but it's really how we estimate it's what we're changing. So if we had original cost minus our accumulated depreciation, that's going to equal what is our undepreciable cost. We're going to subtract our residual value. That's going to leave us what we have left to depreciate. Depending on the number of years we've gone through this, it looks like it's been 2. So we're going to subtract 2 out of the initial useful life of 5, and we have 3 years left. We're going to divide it by 3. Our new depreciation journal entry would be debit to depreciation expense, credit to accumulated depreciation of the 20,000. You definitely are going to need to let people know about that. You'll need to put that in your financial notes of the financial statement. And this is what I think this is what it's saying. Yeah. Error correction. If you find an error, you've got to go back in time and correct the financial statements that the error has. Okay, it's got to be fixed in the prior financial statements. Okay. As that last little couple of sentences here says, if we had an error, we got to, and it impacts the retained earnings, which it usually does. We're going to need to put that at the beginning of our statement of retained earnings. So an error correction, we see what it should have been on the left, what it was on the right. You make the appropriate entries and you impact retained earnings. On the statement of retained earnings, we'll show prior period adjustments. In this case, it would be a reduction to retained earnings by $180,000, fixing it from expensing it, putting it into the asset of a patent where it should have been. Impairment of value. Okay, here's the circumstances. Impairment of value, assets held and used. Could have technology developed, customer demand goes down, whatever. We have impairment. A write down, whether it's partial or full write downs, will be determined based on the impairment. Okay, so here's what we're using them if impairment happens. It's going to be property, plant, equipment, and intangible assets with finite useful lives. They're subject to depreciation, depletion, or amortization, and intangible assets with indefinite useful lives, not subject to amortization. These are the 2 groups we're going to be looking at. So if it has a finite life, we're depreciating it, it has a finite life. We test it for impairment only if something major happens, okay? And if we can't recover the book value, all right, that would be an impairment. Here's some examples. Significant decrease in market value. You have the iPhone 3, we're on iPhone 25. Yeah, significant impairment there. Adverse change in legal factors. You are using something that no longer is allowed to be used due to serious health issues, right? You're using something that's kicking off radiation. You didn't know it. All of a sudden, you realize it's kicking off this major radiation. You got to shut it down. It's impaired. Normally, you depreciate it. It's impaired. Okay. What we got to do in order to recover it? First of all, recoverability test. An impairment occurs when the undiscounted sum of estimated future cash flows from the asset is less than the asset's book value. In other words, we can still make money with it. We got to test and see how much we can get based on future cash flows. And then we measure it. If it's impaired, as in number one, the impairment loss would be for the amount by which the asset's fair value is less than its book value. If it's not impaired from step one, no impairment loss is recorded. Here's our measurement, fair value, the amount at which the asset could be bought or sold in the current transaction between willing parties. I like that, willing parties. Can't force somebody, right? Can't hold a gun to that and say, you're going to buy this. Fair value is not determined. You can estimate it, or you can use, fair value is not determinable. You can use an estimate, but you should go in this order. Quoted market prices should be used if available. If it's not completely written off, whatever the value becomes its new base for future cost, depreciation, or allocation. So here's a situation. I think this is the I'm trying to see. I think this is the notes to their financial statements. And so we're seeing that the book value was 170,000, but 150 million was the undisclosed future cash flows. So the impairment loss is indicated and would be for 20 million. In this case, we got 130 million. Is that different? Oh, wait, no, it's just, no, this was just testing the impairment lost. Now we're going to be looking at how much is that impairment loss, which we got to take the fair value, which is 135. Sorry, I misread that last one. 135,000. Then we take out the original cost minus its accumulated depreciation, subtract that out, which is 170,000 out of 135. We have an impairment loss of 35,000. Now it's possible to have something impaired but not have a loss to it. At which point then I guess it wouldn't be impaired, but so yeah. Anyway, all right, let's move back there. So this is how you're going to calculate it. You're going to reduce the factory assets by the amount of the loss and accumulated depreciation. You're going to reestablish your base. Your factory assets are now valued at 135 and go from there. Impairments and cash flow estimates, undiscounted and discounted. We're not going to go into this majorly, so don't worry about it as much. You can read it if you want. We got to disclose all this information. Don't worry about IFRS. Here's some examples of reporting the situation. Assets other than goodwill, testing for impairment. The fair value is less than the book value. It's an impairment loss for the difference. There's no recoverability test in intangible assets other than goodwill that has an indefinite life. Okay. You can read that about it if you want. Goodwill is unique intangible asset. I'm only worried about getting to the actual impairment. So we're going to compute the value of the reporting unit itself with its book value. If the fair value of the reporting unit is less than the book value, an impairment loss is indicated. Let's just look at some numbers. So we acquired Pharmacopoeia Corporation and had 100 million goodwill. Events and circumstances indicate that it's more likely than not that the fair value of Pharmacopoeia is less than its book value. So the fair value of Pharmacopoeia is estimated to be 360,000, but our book value of holding it with 440 million, including the 100 million in goodwill. Well, that's an $80 million loss, right? So we're going to reduce our goodwill by 80 million because the assets are no longer really worth as much as we had when we bought it. Okay. So that one's kind of an easier one. You just have to know that information. Here's a historical amount of companies that had impairment losses of goodwill. Look at that in the billions of dollars. Billions. AT&T. AT&T used to be a behemoth, and now look, I mean, they're a blip. They're not that bad, but Comcast, crazy. Here's an example of your disclosure. Here is your IFRS if you really want to know. Assets held for sale, impairment losses recognized for any write down if the book value is less than the fair value minus cost to sell, or the residual value we've already talked about. And not the residual value, the net realizable value, basically how much it costs to sell it. We've already talked about that. You can read about this earnings quality if you want. Expenditure subsequent to acquisition. Okay, this depends on whether you're going to capitalize or expense it. You can look at that too. Repairs and maintenance, usually expensed. They're not increasing future benefits. They're just keeping it going. If you're adding a major situation, like you're putting in a new radiator or a new engine to a car, it's going to increase its useful life. You're going to depreciate that. It'll be capitalized. Improvements, same thing if it increases the useful life or the efficiency of it. Three methods to record the cost of improvement: substitution, capitalization, reduction of accumulated depreciation. That's not the three. Improvement, substitution. Oh yeah, here it is, substitution. We're just basically substituting the improvement. We can either capital. Why isn't it showing me the whatever? Sometimes I just don't know what McGraw-Hill's thinking. I really don't. Reduction of the community. Bottom line, this is going through the steps of what to do. I'm going back. We substituted. This is what our journal entry is going to look like. We're removing the old one, putting on the new one. We're just swapping it out. Okay. Capitalization of the new costs. Okay. Debiting the buildings and crediting the cash or whatever the notes payable, whatever the case is. And then reduction of the accumulated depreciation. Sorry, reduction of the accumulated depreciation. All right. This last little part, like I'm kind of just glossing over them because these are a lot of little things. Yeah, you need to know them, but cost for defending intangible rights. I had this guy who I listened to for a while. He talked about how he had a patent and he defended it. If I remember correctly, if it's successfully defended, then you can capitalize and amortize that over the remaining useful life of the intangible. If it's not successfully defended, then you get to expense it immediately. Bottom line is it's still a cost that you don't want to have to defend, but there are a lot of people who like to try and steal your patents. If you don't defend it, try and make them pay for it because they're the ones that are stepping on your toes. So yes, this is a capitalization. I've dealt with several companies, tons of companies that say, like, look, if this is under $1,000, we're just not going to capitalize it. It's just with a multi-billion-dollar company, spend $1,000 on something. It's like, who cares? It's not material, as we say. And maybe I'll stick to some water today or the rest of the day. I've been chugging the Crystal Light. Okay. Makers, if you're interested in taxes, makers is basically just an accelerated form of depreciation. You basically are going to have two different books, tax versus your accounting, because makers is not approved for GAAP. It's basically just a way to kind of spur the economy on. You can depreciate for tax purposes your assets faster. I have helped some people with their taxes in the past before I was a CPA, but after I had gone through lots of college. And we used makers and accelerated their depreciation for tax purposes. So it worked out for them. I don't I'm not gonna, if you see any questions on makers that I missed, I think I don't have any for it. Don't worry about makers. I don't even want to go into that. Okay, retirement depreciation method. Oh, I think this is what the book is calling what I dealt with. Basically, you keep buying stuff, but you're also going to get rid of some. So you just keep basically adding this to this calculator's account. But then when you dispose of some of them, you just, you get rid of the depreciation. You depreciate it as you sell it. It's an interesting thing. It wasn't what I was thinking, but it is. That one's a depreciation. That's interesting. Once you replace something, you can also depreciate it as you replace it, which, again, it's so little. Yeah, if you see something like this is extremely, extremely rare. All right, but that's it, guys. I hope you have a great day. Remember to write that word in. We said earlier in the word in the presentation. If you have any questions, you know where I'm at. Otherwise, you guys have a fantastic day. We'll see you in the next video.